Good day, students. I will be doing chapter 14 in your main textbook, and I will be focusing on exercise 14.2 that is in your textbook. And this exercise is on the direct and absorption income statement. It says Dube and Dube manufacture and sell hand lotion. Their manufacturing overheads are allocated on the basis of direct labor hours. So take note of that. We allocate our manufacturing overheads using the base of direct labor hours. And they say it takes 15 minutes to produce one bottle of hand lotion. So now if it's 15 minutes, we have to convert this into hours, where we say 15 minutes divided by 60 minutes in an hour, and this will give us 0.25 hours. So now that means it takes 0.25 hours to complete one unit of or one bottle of a hand lotion. It further says that standard production for a typical month is 80,000 bottles. So now that is the standard production that we'll use to calculate our predetermined overhead. And says the budgeted fixed manufacturing overheads amounted to 648,000. And take note of the fact that this is given per annum. However, our typical production is given to be per month. Our production is 80,000 units, which is per month. However, our budgeted fixed overheads are given per annum. So now if they are given per annum, then we have to convert to one so that it becomes either per month or another one to become per annum. Then it says that there were 23,000 bottles of hand lotion in the finished inventory storage on the 31st of July 2006. So now that will definitely be the closing inventory at the end of July 2006. And it says Dube and Dube manufactured 85,000 bottles of hand lotion during the month of July. So now that will be the production for the month of July. Manufacturing costs during July are given to us as follows. We are given direct material, we are given direct labor, variable manufacturing overheads, variable admin cost, and we are given 60,000 fixed administration cost, and we are given fixed manufacturing overheads, and we are also given variable marketing cost. So now these are the costs that were incurred for the month of July. And we proceed in the same note. They tell us in the next part that the cream was sold for 11 rand 25 cents per bottle during the month of July. So now this will be the selling price for the month of July. And they say in August. So now this is the next month, which is the month following the month of July. In August, Dube and Dube decided to increase their sales by 10%. So now that means if we increase our sales by 10%, it will be 11 rand 25 cents times by 1.1. Therefore, now we'll see that our selling price will increase by 10%, and that 10% will give us 12 rand 37.5 cents. It will be 12.375 cents, which is the selling price in the month of August, because they told us that the company increased their selling price by 10%. So now that means the selling price for August will be 12.375. I will not round off, I'll just keep the 3 decimals as they are. Then after we are told that the reason for that increase it is because the fixed administration cost increased by 20,000 rands. And take note that our fixed administration cost were given to us, and here were the fixed administration cost. It was 60,000 rands in the month of July. So now we have to add 20,000. And the minute we add 20,000, that means our fixed admin will be a total of 80,000 rands. So now that will be an increase in the fixed administration cost by 20,000 from 60,000 to 80,000. Then it's further say that and direct material increased by 10%. So now that means our direct material must increase by 10% on the 1st of August and in the month of August, the year 2006. So now we have to increase our variable direct material cost by 10%. So I'll do that immediately when we do the total calculations. Then it says 78,000 bottles on hand lotion were manufactured during August. So now this will be production for the month of August. This will be the number of units that were produced in the month of August. Then after, it further says to us that there were 13,500 bottles of hand lotion in the finished goods storage on the 31st of August 2006. So now this will be the closing inventory by the end of the month of August. So now we see that we are given the production and we are also given the closing inventory. And it further say that all other factors remain unchanged. Variable non-manufacturing cost vary according to the number of units that were sold. Take note of that. They say variable non-manufacturing overheads vary according to the number of the units that were sold. That means all the non-manufacturing costs, they vary according to the number of the units that were sold. So now that means we are referring to the variable marketing cost, which is based on the units sold. This is based on the number of the units that were sold. And also there was variable administration, which is also based on the number of the units that were sold. So now we know that these vary according to the number of the units that were sold. And you must just mark that. It's very important. It will help us when we do the allocation. So now we continue to the next step. And in the next stage, they tell us that we must compile income statement for July and for August using the direct and the absorption costing method, and we must also indicate the units per or the unit cost per product for each of the method. So now we need also to calculate the cost per unit for each of the methods that we are instructed to do, which is the direct method and the absorption method. So now before I begin, I just want to start with the missing units all the time. We are doing 14.2. This is 14.2. So now I just want to start with the missing units in 14.2. So now we know that when we're calculating the missing units, it is the missing units for the month of July and missing units for the month of August. And we know that this starts with the opening inventory. And our opening inventory was not given for the month of July, because in the month of July we're only told about the production of July. We were not told about the opening inventory of the month of July. So now if you see here, we were only given the number of units that were manufactured and the one that were there in the beginning. There were 23,000 bottles of hand lotion in the finished goods storage on the 31st of July. And I said this will be the closing of July. And I said Dube and Dube manufactured 85,000 bottles. So now we do have closing inventory and we also do have production. So now we have to make use of what we have, because there was no further information that told us otherwise. Then after, now we have to say plus production. Then we less closing, and we know that production is 85,000 units. Then we write our production as 85,000 units, and our closing was 23,000 units. And we know that closing becomes opening of the next month. Closing becomes opening of the next month. Therefore now this closing will be the opening of the following month, which is 23,000 units as opening in the month of August, which was closing in the month of July. Then after, now we draw a line so that we are able to structure our work very perfect. Therefore now this will give us the number of the units that were sold. So now this will be units sold. To calculate our units sold, we need to say production, in this case, in the case of July, minus 23,000 units, and this will give us 62,000 units that were sold in the month of July. So now let us go in the month of August so that we check how many units were produced in the month of August. In the month of August, the information was given below, and we were told that there were 78,000 bottles of hand lotion. There were 78,000 bottles of hand lotion that were in the storage. 78,000 bottles of hand lotion or were manufactured during August. So now this will be our production, which is 78,000 will be the production for the month of August. Therefore, now we have to check how much is our closing, and our closing, I think it was 13,500 units. So now here we have 13,000. They said there were 13,500 bottles on hand in the finished goods storage on the 31st of August 2006. So now that becomes the closing of August in the year 2006. So now that is why I write that 13,000 as the closing. Therefore, now we have to calculate the units that were sold in the month of August. 23,000, which is opening, plus 78,000, which is production. We add that 78,000, which is production, and we minus 13,500, and this will give us 87,500 units that were sold in the month of August. So now we have calculated the missing units. So we have calculated the units that were missing. So now if we have calculated that, we secondly need to calculate our POR, predetermined overhead rate, before we calculate our cost per unit. We need to calculate our predetermined overhead rate. And remember, our POR is, we are calculating POR for the fixed manufacturing overheads, so that we know what is our predetermined overhead rate. And in doing that, we need to know our budgeted fixed manufacturing overheads. And our budgeted fixed manufacturing overheads was given to us that budgeted fixed manufacturing overheads amounted to 648,000 per annum. And this means it is per annum. Therefore, now we were also given our standard production typical per month, which is 80,000 per month. So now we need to convert another one to have the same time frame, not per month and per annum. So now, in other words, we have to say 80,000 units, we times this by 12, so that it gave us 960,000 units, which is the standard production will be 960,000 units for the full year. Or else we can still convert our total fixed manufacturing overheads, which is 648,000, and we divide this by 12. Any method that you use, it will still be acceptable. So now if you say 648,000 and we divide this by 12, it will give us 54,000 rands. So now this will be 54,000, and this will be per month. So now either way, it's still acceptable to use any method, but I want to convert both of them so that we are able to calculate our predetermined overhead rate. So now our POR will be budgeted manufacturing overheads, which is 54,000 rands. Remember, I am using the 54,000 rands, which is fixed overhead, fixed manufacturing overheads per month. It will be the fixed overhead of 648,000 divided by 12, and this will give us 54,000. And remember, we have production, and our production, standard production hours, it will be 80,000 units, because we are told that the standard production, it is 80,000 units per month. We are told that the standard production, it is 80,000 units per month. So now that means we have to say the 80,000 units per month, and we convert this into the number of the hours. So now in doing that, we say here we have 80,000 standard units. Therefore, now we have to convert this into the number of hours. We have to convert that into the number of hours. Remember, I've also calculated for you. I just removed that. We said that we have 15 minutes to complete one product. Therefore, now I said it is 15, which is 15 minutes divided by total minutes in an hour, and that gave us 0.25 hours. And this is 0.25 hours. That means it takes 0.25 hours to complete one unit. It takes 0.25 hours to complete one unit. So now we have to convert our production into the number of the units, or in terms of the number of hours. So now for us to do that, we have to say production hours is equal to 80,000 units times by 0.25. And if we do that, it will give us the total hours to manufacture 80,000 units. The total hours to manufacture 80,000 units. Therefore, now it will be calculated by saying 80,000. We times this by 0.25, and it will give us 80,000 times by 0.25, and this will give us a total of 20. It will give us a total of 20,000. And if you say 54,000, if you say 54,000 divided by 20,000, this will give us 2.70 cents per hour. So now our PR per hour, it will be 2.70 cents per hour. But we need it to be per unit, don't forget. We need it to be per unit. Then after, now we have to say times by 0.25. Therefore, now we have to ask ourselves, how many hours, if the PR or predetermined overhead rate is 2.70 per hour, how many hours does it take to complete one unit? It is 0.25 hours to complete one unit. Therefore, now when you multiply that, where we say 2.7 times by 0.25, then this will give us 0.675. So now that means it takes 0.675 cost per unit. Our PR is 0.675 per unit. At the same time, if you wanted, you could have done this in the very, very easy way, where you just take the fixed overhead cost per month, you divide that by 80,000 units, and if you use the number of units, then this becomes easy. Remember, this is hours. If you use the number of units, it will give you the correct amount, which is the final amount. Where you say 54,000 rands, you divide this by 80,000, and if you do that, 54,000 divided by 80,000, and this will give you straight to 6.75. This will give us 6.75. Let me check, what am I doing wrong? It will be 50,000, 54,000, and we divide that by 80,000. Yes, if we divide that by 80,000, it gives us straight the correct amount of 0.675. So now if you want, you can just divide the fixed manufacturing overheads by the standard production, and that will give you the PR per unit. Remember, this is per unit. This is per unit. Because we divided by the number of units, therefore now it will give us the final amount per unit. But remember, you were required to allocate or to base your manufacturing overheads using the direct labor hours. So now that is why I am forced to first have to convert the total production units into hours, where we say this time by 0.25, which I said it will give us 20,000 hours. So now we are then forced to first convert this into hours, which is production hours. It is the number of units to be produced times by the number of hours it takes to complete one unit, and that will give us 20,000 hours. And if that gives us 20,000 hours, that is the 20,000 hours that we divide with. Therefore, now that will give us the same total of 0.675. Either way you do it, it does not matter. The second method which you could have used, again, I want to show you all this approach. You could have taken the full 648,000, which is our budgeted fixed manufacturing overheads per annum. Remember, it was already given to us as per annum. You can take that, then after we convert the units, which is the 80,000 units per month, where we say 80,000 units times by 12, and I've shown you that it will give you 960,000 units per annum. It will give you 960,000 units, which is standard production per annum. Therefore, now you can just say divide by 960,000, and if you do that, it will give you straight 0.675. Let us also prove that 648,000 divided by 960,000 units, and because we divided by the number of units, therefore now this will be per unit already. Or else you could have said, which is the last method, 648,000, and you divide this by the total production hours per annum. Therefore now if we need the total production per annum, it will mean we have to convert the number of units into hours, which is 960,000 units. We times this by the number of hours it takes to complete one unit, and when we do that, it will give us the total annual hours to manufacture 960,000 units. Therefore, it will be 960,000 units times that by 0.25, and it will give us 240,000 hours. And if you get 240,000 hours, which is per annum, this is 240,000 hours per year or per annum. Therefore, now you divide by that 240,000 hours, and this will give you surely £2.70. Let us confirm that. 648,000, we divide this by 240,000. This will give us 270, and the 270 is per hour. Is per hour. Therefore, now we need it per unit. We times by the number of hours it takes to complete one unit. And if you say 270 times by 0.25, that will give you the same 0.625. So now that is 675. Either way you do it, it does not matter, but it is very important to check what the requirement is, because remember, this is what was required, because we are required to base our overheads on labor hours. And therefore now either you could have used this will be a mark, or else you could have used this method. These two methods, they are using labor hours, and they answer exactly the way we were required to answer. However, this method and this method is just another method you can use in case you are not specified in terms of how to allocate your overheads. At the end of the day, you get the same amount, but if there's a mark for this number of hours, then you'll get a mark. But if you use the units, you might be penalized if you decide to use units instead of the number of hours. So now I have shown you everything when it comes to the calculation of the predetermined overhead rate whenever you are given the number of the hours as the base or the direct labor hours as the base. Either way you use it, you get straight to the same answer. That is my point. So now I will then continue now to calculate the cost per unit, and I will erase other calculations so that I only have one answer, which is the correct answer. Oh, let me just leave the two methods because they are just parallel. They will not consume my space. So now we have to calculate our unit cost. We have to calculate our cost per unit. And we know that cost per unit, just to use a different color because it's a new calculation, then we say cost per unit. Our cost per unit will have to be for the 2 months, the month of July and the month of August. Remember, there was increase in other costs. We have to take that into account. So now we need our direct material. We need our direct material. And our direct material will have to go and calculate it. We only need it per unit. We have seen that there was an increase in the direct material in the month of August. We need not to forget that. there was an increase in the direct material by 10% in the month of August. So now let us also go and check how do we increase our direct material for the month of August. Remember, there was this part that told us that and direct material increased by 10% from the 1st of August, but we are still busy with the month of July. So now we just have to calculate our direct material for July, then after we increase that by 10% in the month of August. So now let us go and check our direct material. Here the direct material in total, we divide this by production of the month of July, and production of July was 85,000 units. The company produced 85,000 units. Therefore, now if we divide that by the number of units, it will give us the total cost per unit of direct material, 106,250 divided by 85,000. This will give us 1 rand 25 cents. So now this will have been a direct material cost for the month of July, which is 1 rand 25 cents. Therefore, now we have to say plus 10%. We have to say plus 10%. We have to say plus 10%. And after we plus 10%, we get to the direct material for the month of August. So now, in other words, to say 1.25 times by 1.1, and this will give us 1.375. So now if you see that our direct material per unit in the month of August is no longer the same as that of the month of July. So take that into account, is very crucial. At the same time, we could have said, just another way of calculating this, we could have just said direct material, we could have said direct material is equal to 1 rand 25 cents, which is for July per unit. Then we times this by the production of August, because it is the same. Therefore, now we could have said production of August is 78,000 units. Then we could have said times by 78,000 units. Therefore, now this will give us the total direct material cost, which is 78,000 times by 1.25, and this will give us 97,500. This will give us 97,500, and we say times by 1.1, where now we are increasing the total direct material by 10%. Therefore, now we say times that 1.1, it will give us 107,250. It will give us 107,250. So now this will be the increased total direct material for the month of August. And we divide that by the number of units that were manufactured, 78,000. And after we divide that, it will give us the per unit of the month of August. Divide by 78,000. After the increase, it gave us 1.375, which is 1.375. So at the end of the day, we get to the same 1.375, which is the increased direct material cost per unit by 10%, which became 1.375 per unit. So now that will be how you calculate the increase in the variable cost. Then after, we need to take into account the direct labor. And when it comes to direct labor, there was no increase. Therefore, now we know that direct labor is a variable cost, and a variable cost remain constant per unit. Therefore, now if we divide by 85,000, this will give us the total direct labor cost per unit. Therefore, now it will be 340,000 divided by 85,000. And if we do that, we get 4 rand, and there was no increase. Therefore, now it will be 4 rand in the month of July and 4 rand in the month of August. Therefore, now we have 4 rand, and we also have 4 rand of the direct labor. Then after, now we have to calculate our variable manufacturing overheads. Our variable manufacturing overheads were said to remain constant. There was no change in them. Here is the variable manufacturing overheads of 18,700. We divide that by 85,000. And if we divide that by 85,000, it will give us, we say 85,000, 18,700 divide by 85,000. then this will give us 0.22 cents. This will give us 0.22 cents. 0.22 cents. So now that will be 0.22 cents throughout. It will be 0.22 cents. And it will be 0.22 cents. Remember guys, if we wanted, we could have converted everything into becoming hours. Don't forget that. I just want to make sure that I clarified you in this topic completely. If we wanted, we could have converted everything to be per hour. Let me just take the example of the direct the direct labor. Our direct labor is 340,000 rands. We could have divided this by the labor hours to manufacture 85,000 units. So now it will mean first we need to say 85,000 units times by 0.25. I think by now you know what does 0.25 mean. It is the number of hours it takes to complete one unit. So now if we do that, it will give us the total hours to manufacture 85,000 units. Therefore now this will be 0.25, which will give us 21,250 hours. That means it will take 21,250 hours to complete 85,000 units. Therefore now we divide by 21,250 hours. And if we do that, we will see how much we get. It will be 340,000 divided by 21,250 hours. This will be 16 rand per hour. This will be 16 rand per hour. Then we say we are looking for the direct labor cost per unit, not per hour. Therefore now we say per hour, how many hours does it take to complete one unit? It's 0.25 hours. Then you say times by 0.25 hours. And if you do that, you say times by 0.25 hours, you get to the same 4 rand of the direct labor. The same 4 rand that we have calculated previously. There is the 4 rand, there is the 4 rand. Either you use labor hours or either use the number of units, you get to the same amount. Then once again, I want to clarify you again on the second part, where now we have to take into account our variable overheads. Same applies with the variable overheads. The same principle will apply. In the case of the variable overheads, we can do the same thing. Our variable overheads, in this case, they are an amount of 18,700, and we know that our total hours to manufacture 85,000 units is 21,250. So now we can just say variable manufacturing overhead. It will be 18,700. We divide by the total hours to manufacture 85,000 units, which is 21,250. Therefore now if we do that, it will give us the rate per hour, which is 18,700 divided by 21,250. This will give us 0.88, which is per hour. But we want to calculate it per unit times by 0.25, which is the labor hours per unit. So now if you say times by 0.25, this will give us 0.22. 0.22. So now either way, you get to the same figures. It's 0.22. Either you use the labor hours or either you use the unit cost, but unit cost is very easy because it just gives you the final answer. However, you might be tested where you have to calculate using number of machine hours or number of labor hours. So now I'm doing this because I know that you might be tested in any way and you need to master all these approach or methods in terms of allocating your overheads. So now in this case, we can calculate our absorption cost plus 4 plus 1.25. That will give us 5.47. Then after we say 5.47 times by 1.1 if you want, or no, it will be 1.375 plus 4 plus 0.22. Then this will give us 5.595. So now this will be our two cost, which is variable cost per unit, variable cost per unit. Therefore, now we have to add our fixed cost per unit. We have to add our fixed cost per unit. And now we have to go and check our fixed cost. We have already calculated our fixed cost. There is 0.675 per unit. It is 0.675 per unit. Don't forget, it is 0.675, and there was no increase, 0.675 per unit. We have already done that beforehand. So now with that, then we can calculate our absorption cost per unit. Our absorption cost per unit. Our absorption cost per unit, and we know that our absorption cost per unit will be 5.47 plus 0.675, and this will give us 6.145, and this will give us 5.595 plus 0.675, and it will be a total of 6.27. This is a very crucial part to take into consideration. Very crucial, because this will determine the calculations of your income statement. So now from here, what I want to do is to calculate the applied overheads. The applied overheads. But remember, we already have our POR. POR times by the base will give us the applied overheads, so that we determine if did we have over or under applied manufacturing overheads. So now in doing that, we have to say for the month of July and for the month of August, where we have first have to determine actual fixed cost, and our actual fixed cost, we know that it is an amount of 57,000 rands. Here is the fixed manufacturing overhead cost of 57,000 rands. And there was nothing that said our manufacturing overheads fixed will change. There was nothing. Our fixed manufacturing overheads, they remain the same. The only fixed cost that increased was the fixed administration. It went up by 20,000. Otherwise, fixed manufacturing overheads remain the same. Remember, I said all other factors remain unchanged. So now that means our fixed overheads will remain at 57,000 for both months, which is actual, 57,000 for both months, which is actual. Therefore, now we have to calculate applied overheads. And we know that to calculate our applied, we say POR, and our POR predetermined overhead is 0.675 times by the actual base, times by the actual base. And remember, this is 0.625. Is it per unit or per hour? It is per unit. So now if this is per unit, therefore now we can just multiply by the number of units, which is actual production for the month of July. So now if we do that, we say, okay, what is the production for July? Production for July is 85,000 units. So now that means our applied overheads will be applied for July. Our applied for July will be 0.625, 0.675 as 0.675 times by 85,000 units. Therefore, now let us check how much do we get. 0.675 times by 85,000. This will give us 57,375. 57,375. Remember, we were allocating our overheads using the number of labor hours, not the number of units. So this method is in question a little bit, but the amount is correct. So now that means if we are applying based on the requirements or based on the information that was required, we first have to convert the 85,000 units that were produced into hours, 0.25. Therefore, now if we do that, we'll get to know how many hours does it take to complete 25,000 or 85,000 units. And we already know that it is 21,250 hours. So now that means we could have said 21,250 hours times by 0.625. Then let us see how much do we get. Then you say times by 0.625, and this will give us 14,343. Then we times that by 0.25. It gives us, okay, let me leave that one. I wanted to test both of them, but let us leave it at that. It's going to take time for me. So now we have seen that it is 57,375. Therefore now we allocate that as our applied for the month of July, which is 47,000 or 57,375. 57,375. Then now we do the same thing, calculate applied for the month of August. Calculate applied for the month of August. So now we are calculating applied for the month of August. Therefore now it will be our POR times by actual production for the month of August. And production for August was 78,000 units. Yes, there was the production for August, 78,000 units. Therefore now say POR times by the actual units, which is the actual base. Therefore now this will give us the total of times by 78,000 units. 78,000 units. And if we do that, this will give us a total of 0.675 times by 78,000 units. Then this will be 0.675 times by 78,000. It will give us 52,650. So now I've discovered the way that I wanted to use before. So now we can use another method where we take this, we multiply this by the number of hours, which is times by 21,250. And if we do that, it will be 2.70 times by 21,250. We get to the same 57. Yep, that's what I wanted to prove to you. Previously, you could have said the rate per hour times by the number of hours, which is 21,250. You still get to the same 57,375. Yep, 57,375. That's what I wanted to prove previously. So now again, we have calculated that. Then now we must allocate this amount where it is supposed to be allocated. Then now we have to record that amount which we calculated as, okay, let me recalculate it, where we take 2.70, we times this by the number of hours. Let us check our number of production hours. We know that it will be 78,000 units, and we know that it takes 0.25 to complete 1 unit. Therefore now 0.25 times by 78,000 units. Therefore now this will be 19,500 hours. That means it takes 19,500 hours to produce 78,000 units. Times this by 2.70. This will give us the same 52,650. So now you can see that things are honestly making sense. 52,650. Or else I said, remember, you can just take that 0.625, which is per unit. If you take this amount, take note of this. If you take your POR, which is per unit, this is 0.675 is per unit. Therefore now this has to be multiplied by the number of units. And if you take again this 0.75, you must multiply this by the number of units. But if you take the 2 rand 70, which is per hour, therefore now you first have to convert the hours. That means the hours it takes to produce 85,000 units. Where you say times by 0.25, and this will give you 21,250 hours. So now when you get 21,250 hours, you multiply the hours with the rate per hour, which is the rate per hour, which is 270. So now when you do that, it will be 2.70 per hour times by 21,250 hours. You get to the same 57,350. As I said, just to emphasize and get you to refresh on this. Again, if you want to take the rate per hour, which is the 2 rand 70 per hour, in the case of the month of August, when you calculate applied, you can first convert the total production of August into hours. Of which here the production of August, and you say how many hours it takes to complete 1 unit, it is 0.25. Then you say 78,000 times by 0.25, that will give you 78,000 times by 0.25. That will be 19,500 hours. I've calculated, it's still there on top. Therefore, now we say 19.5 hours times by the rate per hour, which is the 2 rand 70 per hour, times by 2 rand 70, which is per hour. That will give you the same 52,260. So now with that, I think I've given you all that you need to know with regard to the calculation of the POR and the applied overheads when we are given a different base. So now I have touched base on that. Then we can move forward. So now we know that there is actual and there is also applied. Therefore now we have to subtract another one, and after subtracting another one, we determine if have we over or under applied, or have we over or under estimated. So now it will be 52,650 minus 57,000, and this will be 4,350. Then it will be 57,000 minus 57,375. Then it will be 375. Obviously here we have over applied. This is over, this is under. This will be plus, this will be this will be a minus, this will be a plus. This is overestimation and this is underestimation. So now we have done the over and the under applied, and from here now we can straightly do the two income statements. And in doing the two income statements, therefore now we have to start with the direct income statement, and we do the direct income statement for the 2 months of July and August. Direct income statement, and this is for July and for August. This is for the month of July and for the month of August. And we know that we start with the sales. We know that we start with the amount of sales, and we say our sales, and our sales were 11 rand 25 cents. 11 rand 25 cents times by 62,000 units that were sold. If I still remember, there were 62,000 units that were sold in the month of July. So now we times that by 62,000, and it will give us the amount of sales as 697,500. 697,500 rands. And remember, there was an expected increase in sales by 10%. And we increased our sales by 10%, and they become 12.375. Our sales were previously for July 11 point, and they went up by 10%. There was the sales increase by 10%. So now we have increased them by 10%, and our sales per unit became 12 rand 375, and we have to multiply that by 87,500 units that were sold in the month of August. And in the month of August, I think our sales were 87,500. And here are the sales, 87,500. And if we do that, it will give us the amount of sales for the month of August. And in the month of August, then we record that as 1082813. So now here are the sales for the month of August. Let us not round off and leave those cents as they are, 82.5, because there was also no instruction. Then after we less variable cost, and our variable cost, we know that we start with the opening, and there was no opening inventory in the month of July. If you still remember, there was no opening inventory in the month of July, so nothing changes. Don't forget this closing. Don't forget this closing. I will explain it to you soon. So now we add our production. Then after we less our closing. Then after we have to take into account plus, we have to plus our variable cost, all the variable cost. And in this exercise we also had other variable costs, and those variable costs were variable administration cost of 42,160. Then we have admin cost 42,160. And we know that all the variable non-manufacturing overheads, they vary according to the number of units that were sold. I did explain that to you. All the variable, they are based on the units sold. So now we know that there were 62,000 units that were sold in the month of July. So now we need to determine our variable cost per unit so that we use that for the next period. It will be 42,160 divided by 62,000 units that were manufactured. This will give us 68 Rand as the variable administration cost per unit. Variable admin per unit. Variable admin per unit sold. It will be 42,160 divided by 62,000 units that were sold in July. This will give us 0.68 cents. Then we times this by 87,500, which are the units that were sold in the month of August. Therefore now this will give us variable administration cost for the month of August as 59,500. 59,500 will be for the month of August. Variable administration cost for August will be 59,500 rands. 59,500 rands will be our variable administration cost for the month of August. So now we have to take into account another variable administration cost that vary with the number of units sold. Variable marketing cost 25,420. It is 25,420. This is marketing cost, which is 25,000 just to confirm, 25,420. It is 25,420, and remember this is based on the number of units sold. So now if we need variable marketing, if we need variable marketing per unit, it will be the total of 40 or 25,000 for 20 divided by the units that were sold in the month of July. Therefore, now this will be 25,000 for 20 divided by 62,000. We have 0.41 times by the number of units that were sold in the month of August. Then we times that by 87,500 and it will give us 35,875. 35,875. It will be 35,875. Therefore, now that will be 35,875 variable marketing cost in total for the month of August. So now we still have to deal with the opening and the production. Now our production for the month of July. Our production for the month of July was a number of units. It was 85,000. 85,000 times by the variable cost per unit. Remember, this is the one that we are dealing with now. We are dealing with the direct method or variable method. Therefore, now it will be 5.47 for the month of July. So now the units that were produced in July, which is the 85,000, they were produced at the cost of 5.47. So now that means it will be 5.47 times by 85,000 units. Therefore, now this will be the production for the month of July. Therefore, now it will be production for the month of July 464,950. 464,950. 464,950. 464,950. Then remember, we still have to subtract our closing. Then for our closing, it will be 5.47 times by, and our closing inventory for the month of August, it was 23,000. So now 23,000 will be the closing, meaning 125,810. 125,810. It will be 125,810. Remember, the closing value of the inventory becomes the opening for the next month. That does not change. Therefore, now it will be exactly the same. Just change the color. It will be opening of 125,810. That means the opening inventory of the month of August is based on the cost of the July month. But when it comes to the production of the month of August, the production of the month of August will be based on the cost for August. The production of the month of August will be based on the cost for August. Remember, the cost for August increased by 10%, which resulted these two figures not to be the same. So now these two figures were no longer the same. Why? Because there was an increase in the direct material by 10%. So now that means the opening inventory, which is the opening that we are talking about here, the opening of 125,810, which is the opening units of 23,000, it will not be based on the amount of 5.595, but it will be based on 5.47. That is why I just transferred that opening, and in fact, and hence I transferred the closing straight into becoming the opening, so that I don't make a mistake of calculating the opening inventory of the month of August based on the cost of August, yet that was based on the cost of the month of July, which was 5.47 before there was an increase in the material cost per unit and in total. So now I have also explained that to you. Then now in the month of August, we are taking the 5 Rand 595 as our cost for the month of August to calculate our variable cost. So now we have to say we have 5.595 times by the production, and the production was 78,000 units. production for August, it amount to 436,410 because we had a total of 78,000 units that were manufactured in the month of August. So now that will give us the production of 436,810, which is based on the cost of August. But this was based on the cost of July. That is why we said 5.47 times by 23,000 units. If you want to prove this, we have to take, just to make sure that you are clear with this, we took the 5.47 and we multiply that by the opening units, which is the opening of 23,000, because the opening of 23,000 was the closing in the month of July, which was produced in the month of July. So now that is why we say it was produced in July, and the cost of July was how much? The cost of July was 5.47, not 5.595. Please take this into consideration whenever you are doing this topic. So now that is why we said 5.47 times by 23,000, and if you do that, you will surely get to the same amount. 5.47 times by 23,000, that will be 125,810. So now that is why we base that on the previous cost, because it was incurred in the previous month. Then after we go to our closing, and our closing will surely have to be based on the cost of the current period, and closing was 13,500. Then after we say 5.595 times by 13.5, if I'm not mistaken, this will give us a total of 75,510 32.50. Let me just confirm that the closing was 13.5. Yes, closing was 13,500 for the month of August. So now that I am accurate and correct. So now we have calculated all that need to be calculated with regard to variable cost. We have added everything that must be added with regard to variable cost. Then this will give us marginal contribution. This will be giving us contribution. They normally call it marginal contribution. Marginal contribution. This will be a marginal contribution. Draw a line here and we draw a line here. So now to calculate, it will be our production 464,950 minus 125,810 plus 42,160 plus 25,420, and this gives us a total of 406,720. A total of 406,720. 406,720. This 406,720. And for the month of August, we have 125,810 plus 436,410 minus 755, 32.50 plus 59,500 plus 35,875, and this gives us 582 062.50 062.50. Then now we with that, then we can determine our marginal contribution. We'll say minus 1.82 812.5, and that gives us a total of 500,750. 500,750. And here it will be 697,500 minus 406,720, and this will give us 290,780. So now this will be our marginal contribution. And take into account the fact that when it comes to the direct income statement, we take our sales, we minus all the variable cost, variable manufacturing and variable non-manufacturing cost, starting with the opening plus production minus closing. Remember, this was a variable administration cost. It's a variable administration cost, not the fixed one. This is variable administration cost. This is variable marketing cost. So now everything that is variable or variable, then you take it into consideration. Then after you have got all the variable cost, then you say opening plus production minus closing plus variable cost, that will give you the total variable cost. Then you say sales minus variable cost, that will give you marginal contribution. Then now after you have got the marginal contribution, there's only one element of the cost that has not been accounted for. Fixed costs have not been accounted for. Therefore now we say less fixed cost. All the costs that are fixed, less fixed cost. And we have fixed manufacturing cost, we had fixed manufacturing of 57,000, and there was fixed manufacturing of 57,000. It remained the same if you still remember that. We had fixed manufacturing of 57,000. Our fixed manufacturing, yes, fixed manufacturing overheads, it was 57,000, and that remained the same. There was another fixed administration cost of how much? 60,000. Remember, there was an increase by 20,000 here. And we said if this goes up by 20,000 up, then it will be up to 80,000. Let me show you where did that say to us. There was a time where they said selling price will increase by 10%, and this is because fixed administration cost increased by 20,000. So now in the previous month it was 60,000, which is the month of July. Then it must increase by 20,000 in the month of August, so that it becomes 80,000. So now that is why our admin cost, it will be 60,000, and here it will be 80,000 rands. Therefore now this will be admin cost. This was fixed manufacturing cost. We are only recording everything that is fixed. Therefore now this will be giving us the profit. This will give us the profit or a loss. It could be a loss, it depends. So now we have to say 57,000 plus 60,000, and this will give us 117,000. This will give us 117,000. Then after we say 117,000 minus 290,780, and this gives us a profit of 173,780. Then after we say 57,000 plus 80,000, and this gives us 137,000 of the fixed cost. Then you say minus 500,750, and this gives us a profit of 363,750. So now this will be the profit for the direct method. And please take this rule into account, and you'll see when I do this. We have our direct profit, and there's a rule in cost accounting with regard to this topic, and that rule they call it the golden rule. At third year, this will be called a golden rule. And the golden rule, as I will be explaining to you, what does it say and what does it mean. The golden rule says that if opening inventory is less than closing, then absorption profit will be higher than direct profit. That is the golden rule. If opening inventory, I will write it down. The golden rule says if, some lecturers called it a golden rule, which says if opening inventory is less than closing, if opening inventory is less than closing, then absorption profit will be more than direct profit. Let us check if how is this going to happen in this case. And remember, now we are saying if opening inventory is less than closing, or is less than closing, forgot that, is less than closing, if opening inventory is less than closing, then absorption profit will be more than direct profit. That means we can immediately perceive that from the scenarios that are given to us in this case, where we see that the opening inventory is 0 in the case of July, and if the opening is less than closing, of which is less than closing because it's 0, therefore now this means our absorption profit in the case of July will be higher than that of direct method. And in the case of August, we see that our opening is 23,000 and our closing is 13,000. So now in this case, our opening is less than the closing. Therefore now that means the absorption profit will be less than that of the direct absorption profit, that of direct profit. So now it means in this case, direct profit will be higher than absorption profit because our opening is less than the closing. Let us check if that will be happening as we do our absorption income statement. So now let us check that and we do our absorption income statement and see if this golden rule will apply. And remember, this golden rule, the vice versa is also correct, to say if opening is more than closing, if opening is more than closing, then absorption profit will be less than direct profit. So now this is the golden rule. There is the golden rule. So now let us continue with the second income statement, which is absorption income statement. Then absorption income statement, and the absorption income statement is for the 2 months, which is July, and also for the month of August. We have July and we have the month of August. And we start with our sales, but in this case we say less cost of sales. So now our sales, remember, they will not change, they will remain the same. 697,500 will still be our sales. 697,500. And sales for August will be 1082,812, 1082,812, 1082,812.50. So now that will be our sales for the month of August. And under our cost of sales, we have our opening plus production, then after we have to minus closing. Then after subtracting the closing, we have to say plus or minus over slash under applied. If there is over or under applied, we have to take this into account here. So now our opening, remember there was no opening here, but now we have our production, and remember we are doing absorption. So now in the absorption, we have to take the cost that is inclusive of the fixed cost, which is the cost at the bottom. There is the absorption cost per unit. Remember the difference between the two methods. Another one does not take into account fixed cost. Therefore, now we treat fixed cost as period cost. Another one take into account the fixed cost in the calculation of the product cost. So now we take our absorption cost per unit, which is inclusive of the fixed cost. Because a variable one, it only takes the variable cost, because it's called variable income statement. It only takes into account the variable cost. But absorption, which is normally called full costing, it takes all the cost, fixed and variable. So now we are taking that 6.145 and we multiply that by our production, 6.145, and we know what the production is, 6.145. We say 6.145 times by 85,000 units that were produced in the month of July. So now that will give us production of 522, 325. Production of 522, 325. Then now we say our closing will be 6.145 times by the closing of, and we know that our closing was 23,000, and that will give us a total of 141,335. So now after we have taken the closing, we know that the closing becomes the opening of the next month. Therefore now it will be 141,335 rands. So now we have to now take into account the over and the under, and remember we had 375 here, and we said that 375 we recognize that as over, therefore now it will be negative. Why? Because our actual was less than the applied. So now we have over, and because of that we have to subtract the 375. And also for the previous month, we realized that there was an under of 4,350, and that 4,350 will be recorded as positive, which is 4,350 rands. Then now we go straight to the production of, that was supposed to be here, 141,335. Then we go straight to the production of the month of August. And the production of the month of August will be based on the cost of August. It will be based on the cost of August, and the cost of August was 6.27. This was 6.27. Therefore now we have to multiply our production and the closing by 6.27 units. So now let us continue with that, and we know that production for the month of August was 78,000 units, and the closing was 13,500 units. So now we are doing that calculation immediately. Then you say 6.25, 6.27, 6.27 times by 78,000, which is production of August. Then that will give us the production for the month of August. Then we record that under production, and it will be the total of 410.89, 410.89, 060. Then now our closing, which is 13,500, it will be 6.27 times by 13,500, and this will give us 84,645. 84,645. 84,645. So now this will be our closing inventory. Don't forget this once again. Our opening units. Our opening units is 23,000 units. Our opening units is 23,000. But this 23,000 is not based on the production of August. This 23,000 opening was produced in the month, it was produced in the month of July. So now it came here and it was transferred here. So now when this 23,000 was produced in July and was not sold, remember it was produced when the cost was still 6,145 or 6.145. That is why we say 6.145, which is production cost for July. We times that by 23,000 and it gives us opening for the month of August. Not using this cost, because this is the cost for August after there was an increase by 10%. So now take note of that. It is very crucial. So that's where that 141,335 is coming from. And that is why we transfer the same amount, because it was produced in the month of July. So now with this being said, therefore now we can be able to calculate our cost of sales and withdraw the line in between to show the amount that we have added all together. So now this will be the cost of goods that were sold. So now in doing that, we'll say 522,325 minus 141,335 minus 375, and this will give us 380,615. This will give us 380,615 rands. Then after, for the month of August, it will be 141,335 plus 489,060, and you say minus 84,645, and you say plus 4,350, and this will give us 550,100, 555,100. Therefore now this will be 550,100. 550,100. Remember, this is the cost of sales, and cost of sales is recorded as negative. Then after, now we'll be able to say minus 1082,812.5, which will give us the gross profit of 532,712.5. This will be our gross profit. This will be our gross profit. For the month of July, it will be 697,500 minus 380,615. So now this will be a total of 316,885. This will be our gross profit. Then after we have calculated our gross profit, then now we can be able to then deduct all the non-manufacturing overheads. We can deduct all the non-manufacturing overheads. So now let us go to the non-manufacturing overheads. This is the gross profit. And if you see, we did not say gross profit here. We said marginal contribution. Why? Because fixed costs were not yet taken into account. It was just sales minus variable cost that gave us contribution. So now in the case of the absorption, because all the costs have been taken into account, therefore now this will give us the gross profit. And the last part is to less non-manufacturing cost. Less non-manufacturing cost. Non-manufacturing cost. All the non-manufacturing costs are added here. And the non-manufacturing cost that we have, it was marketing and administration, if I still remember. We had marketing cost and administration cost. Here we said marketing cost, there was the marketing cost, and we also had fixed administration cost, and there was no any other non-manufacturing cost, or there was also variable administration cost. So now we add all of them. It will be variable administration cost, fixed administration cost, and fixed marketing cost. Variable admin, fixed admin. It will be variable admin, and our variable admin. Then we also had fixed admin. Then after we had fixed marketing. We had fixed marketing cost. So now we are just summarizing this part. And don't forget the golden rule. Don't forget the golden rule. So now we already had our variable admin cost from the previous one. Our admin cost was 42,160 and 59,500. 42,160, 42,160, and 59,500. Our fixed admin amounted to 60,000 and 80,000. Our fixed admin, it was 60,000, and it went up by 20,000. It became 80,000. Fixed marketing. Fixed marketing. Marketing, or our marketing is not fixed, it is variable. Our marketing, it is variable. Okay, it's variable, not fixed. Then our marketing is variable, is not fixed. Let me recognize that. We have variable marketing. Then our variable marketing will appear under variable cost in the previous one. 25,420. 25,420. Then after we had 35,375. Hope I captured the memo right. 35,875. 35,875. That was our variable marketing. Then now with that being said, therefore now it means we can calculate our total non-manufacturing cost, 42,160 plus 60,000 plus 25,420. This will give us 127,580. Then it will be 59,500 plus 80,000 plus 35,875, which will give us 175,375 cents. So now we have covered the non-manufacturing cost, which will have to be subtracted, although I said minus. Then you say minus 532,712.50, and this will give us 35,000 or 357,337 rand 50 cents. And for the July month, it will be 885 minus 127,580, and this will give us 189,305. Let us compare the profits and see if does the golden rule apply. Let us compare the profits. The profit for the month of August in the in the direct method, you see 363,000. 363,000. And in the month of August here we get 357,000. Do you see that the profit for absorption is less than the profit in the direct method in August? It is less. The one for absorption is less. Why it is less? It's because of the golden rule, which says if the opening inventory is more than the closing inventory, then absorption profit will be less than direct profit. That's exactly perfect. And also, if the opening inventory is less than closing, then absorption profit will be more than. And we see in the month of August, in the month of July. In the month of July, the opening was less than the closing. That means the closing was more than the opening. And if that is the case, that means absorption profit will be higher than that of direct method in the month of July. And let us check if that is the case. We have profit of the direct method 173,780, which is less than that of 189. So now we can see that the golden rule really does apply. Then now let us do the last part, which is the reconciliation. And after I leave you in peace. Then we do reconciliation. Reconciliation. Then we say in the reconciliation direct profit. We say direct profit. We are required to do it only for the month of July. And the direct profit is 173,780. 173,780. 173,780. And there was increase in inventory. Our inventory increased from 0 to 23,000. Opening was 0, closing was 23,000. This is 173,780. Therefore, now we multiply this by 0.675. Remember, 0.675 is the fixed cost per unit. Our fixed cost per unit was 0.675. This is the amount that we multiply with when we reconcile the difference between the profits. Not periods, but the difference between the profits. So now it will be 0.675 times by 23,000. Then this will give us 15,525. And if we do this, it will give us the absorption profit. This will give us the absorption profit. We say plus 173,780, and this is 189,305, which is exactly the same absorption profit for the month of July. There is exactly the same. So now our reconciliation is correct. You can apply the same approach when it comes to the month of August. And I think I have now covered all that I had to cover with regard to responding to this question. And that was the second part where I have to reconcile the difference in profits, if there is any difference in profit. And with that, guys, being said, I'll say thank you. God bless you.